Hello, today we will start with a new chapter, depreciation for class 11, commerce, 11 commerce accounting. So it is chapter number 7. Here question number 2 we are going to start. Question wise we will go and we will explain, then you will know. Otherwise theoretical portion if you will cover, it will become very big. Theoretical and example you can read from the book also. So from second we are starting. So in this question, what is the main thing? Main things are that you have to prepare a machinery account, and along with machinery only depreciation account. Two accounts they are asking. So when you are asked to make machinery account and depreciation account, the entries will be in this way. Okay. In other questions, other type of accounts when they will ask, we will explain in that question. So here depreciation calculation method also they are taking as a fixed method. Fixed method means once machine is purchased, its depreciation will remain the same throughout its life. Life means the machine is in use at the business or in the plant machinery in your factory. Okay. So fixed method means once it is calculated, it will remain same for the whole life. So how it is calculated? It is calculated cost plus installation plus suppose any repairs you are doing. Okay, so that will also or overhauling you are doing. So all those things will come under installation. Installation covers wages for installation, wages, then your overhauling expenses. Okay. So first it is added. Then from this the salvage value. Salvage value means scrap value. Scrap value. When it will be sold as a scrap. Scrap means not in use in the factory. In that way, when it will sold, the value you will get that is reduced from the total cost. From total cost it is reduced. Whatever amount will remain, it is divided by the life of machine. Life of machine. Life of machine means the machine will be in use in the factory. So here it is 12 years, so we have divided it with 12, and annual depreciation 9,000 at the rate of fixed rate we have. Here rate is not given, only we have calculated. Okay. Now how it will be done? So you have to first see when the closing date is. Every year when the accounts are being closed and when machine is purchased, that is very important. That also you have to keep in mind. So in this question, machine is purchased on 1/7/10, 1 July 10, and so it means up to cost is 1,800 and the installation cost is added to it 12,000. So the value of machine is now 1,20,000 debited, and it is debited to machinery account because all debits are assets. All debits are assets. So it is debited to machinery account. Now at the end of the year, depreciation is applied because it is only two accounts they are asking to prepare, depreciation account and machinery. So here the depreciation will be directly credited to the machine account. Okay. So depreciation first we will calculate for 1 July to 31st means 6 months. July, August, September, October, November, December, 6 months we have calculated. On how much? On 1,20,000. So you see for an annual year 9,000. So for half year it will be 6 months. Half year means 6 months. It will be rupees 4,500. Okay, so 4,500 will be the depreciation. Balance we will take down. So this balance comes to here. At the next year, start of the next year, it comes here. So this balance will come here. This balance comes here. Okay. Now again the depreciation, but this year it will be full year because nothing happens. So full year depreciation is 9,000. So by depreciation account, machine account is created by 9,000 and balance is created. Then again this balance will be carried over to the next 112. And here again on 31st you will apply for whole year and balance is carried. So this balance you have to put in this way, and this is the full account you have done. Okay, why depreciation and now depreciation account? Depreciation account, you see, you have created machine account by this debit. By what denotes debit? By what denotes debit? So by this debit, so you have debited depreciation account. So depreciated account is debited to machinery account. And two word always denote credit. So you have created machine account. So machine account is created. Machine account is here created and depreciation account is debited. Your journal entry is always machinery account debit, depreciation account debit. Your journal entry is depreciation account debit to machinery account. Okay, it is for this entry. So depreciation account is debited to machinery account 4,500. And then at the end of the year, you always transfer the balance to PL account. So at the year end, what entry we do? We do PL account debit to depreciation account. Okay, this entry we pass PL by means debit to PL account debit or credit to depreciation. You see, when you are preparing P&L account, you may remember what we do. We write here to depreciation on machine, and then we put a entry here. Means PL account is debited, and to depreciation account is created. That's why in this entry comes in the PL account. Okay. Now this next year again the amount 9,000 will be transferred and entry will be this account. So from depreciation account always you will transfer the value to the asset account. Always at the year end you close the account by transferring to PL account. By this way, this question is over. Here we have learned fixed rate method calculation and how when depreciation account is only maintained, how machinery account is prepared. This also we have learned. And the basic journal entry we have learned, and machinery purchase entry, journal entry. What will be machinery account debit? Journal entry will be machinery or plants, whatever is there, machinery account debit to bank account. This entry is your this entry. Okay. Either it is cost or installation, entry will be this. Machinery account debit, plant account debit to bank account. Okay. Asset account debit to. Okay. This question is over. Now we'll go to the third question. Now question number 3 we are taking. Previously question number 2, in that only 2 accounts we are preparing, machinery account and depreciation account. But here instead of we have to prepare a provision for depreciation account also. Means one extra account we have to prepare that we were not doing in the previous question. So here how we do the question? Here always machinery account will be at cost price. You have to maintain the balance at the cost price. Whatever in your actual position, the actual position comes here. It shows always actual possession. Means cost only, possession, cost only. Means no depreciation entry will be passed here. And it will, whatever the balance is there, it will be always there. And if it is sold, then balance will be reduced from this account. Cost will be reduced. You see, whenever you are selling any machine, suppose in this 3014, you will sell any machine, its balance will reduce, but the last ultimate balance will be actual possession of machine at your hand. Machine at your hand. Machinery in balance sheet. Whatever machinery is coming, it will always show here. Machinery account in the asset side. Machinery 84,000. It will always be on the asset side. It will always remain at the cost. Okay. So in this way, first machine is purchased for 1 October. So to bank account and to its installation cost, whatever is there, we have debited to the machinery account and balance casted. And this balance will go on running every year. Okay, this will go on running every year. You have to put the entries in this way. Okay. Now, the next account comes as a depreciation account. So, first you see the depreciation calculation. Here, depreciation calculation is always cost plus installation minus salvage value means scrap value. Salvage means scrap value. scrap value, whatever we will solve as express, divided by number of years of the machine in use. That machine will remain in use. So in this question, it is cost is 56,000 and 28,000 is the installation cost. So, and in that is the scrap value is 6,000. That we will reduce to 78 divided by 50. It comes to 5,200 per annum. And whatever the sale of expenses, later on when this 6,000 will come, in that year, we will pass an entry of this expenses of sale, we will do there. Okay. Here it is not required. Here only the depreciation will be calculated in this way. So 5,200 per annum, it means for 6 months. First year, always be careful. Be careful for this date. It is 1st October, means October, November, December, and they are closing the books on 31st. Reliance company closes business accounts every year on 31st March. So you have to calculate every year. So you have to calculate depreciation from 1st October to 31st March. That is 6 months. So 6 months means half of it will come. So by depreciation account, 2,600 will come here. So how depreciation account goes? So depreciation account is always debited. PL account is debited and credited to depreciation account every year. Okay. So it is 2,600. I have written it wrongly. 2,600. Okay. 2,600 first year. First year it is 2,600. Okay, 2,600. Amount, whatever in the question, every question it may vary, but type of entry I am discussing, you have to learn that only. So every year you have to, these entries are passed. In the PL account, it is debited, and in the balance sheet liability side, it comes provision for. It is a credit entry, so provision for depreciation account always comes to the liability. And machinery is an asset, so always it will come at the cost price without depreciation, without deducting depreciation at the cost price, it will come. Why it will come? Because you are maintaining provision for depreciation account. So whatever first year's depreciation, it will go to the depreciation account. Next year again, from PL account, you will withdraw the amount 5,200. And the balance will be, the full amount will be transferred to that account. So everywhere it is calculated on the cost, because you are taking this fixed method. It is a fixed method, the number of years are given. It is a fixed year. Reliance company is using fixed method it is using. So 5,200 every year you have to make the depreciation of 5,200. So basically you have to learn how the provision for depreciation account is maintained. Machinery account at cost price you have to maintain. Whenever anything is sold, that entry will come here. And I will explain in another question how it comes. Okay, then there I will explain. And machinery account is this one, and the provision for depreciation, it is always stated with depreciation account. You remember this. Then this balance will come to this balance goes. This balance comes here. Then from here it comes this side. Okay. Then again from here it comes to this side. From here it comes to this side. From here it comes to this side. In this way it comes here. So you have to learn. First year it will come in the month basis, and again you have to make it from where this account gets the money. Provision for depreciation. It gets the money from depreciation account. So this entry you have to learn every year. You have to credit entry by depreciation account, or whenever any machine is sold, at that time also you have to credit this account by depreciation account. Okay. So this is the way how it goes on. And here the balances. And this is the position. Now we will take a question where machine is sold. So depreciation you have to transfer to another account, and the balance will also reduce. So in that type of account, we are going to take third question. Third is over. Now question number 6 we will do. Hello. Now question number 6 we are taking. In this question, it is the same as question number 3rd. But here, up to here and here. Previously also one machine or furniture or any asset account was there. And provision for depreciation. Accumulated depreciation, provision for depreciation. These two accounts are there. So there I have told if assets account is always shown at the cost side, and whenever anything is sold, sold entry is put here. Okay, so this is your new one extra entry you are seeing here, furniture disposal account. You are seeing this account, furniture disposal account. This is the new account which we are making here. Okay, this is the one of the new account here coming here. And accumulated depreciation is the same as your provision for depreciation account. Provision for depreciation account, I told, it gets the amount from depreciation account every year. Every year it gets the account from the depreciation account. And whenever any asset is sold, whenever any asset is sold, the value, up to for the current year's value, it gets from the depreciation account. Like every annually it is getting depreciation. So when a machine is sold, at that time also it gets the amount here. Okay, it is for your 3 months. It is for the 3 months. 3 months, it will get from depreciation, it will get. And this is your annual, whatever annual depreciation it is getting, it is the annual depreciation every year. So now we are coming to the entries, and first I will explain the calculation so that it will be easier. So furniture is purchased. The furniture purchased, 2 furnitures were purchased. One was purchased for 4,50,000 and another was purchased for 3 lakhs. One was purchased for 4,50,000 on 1/10/15, 1/10/14. So, and the other was not purchased on 1/3/15, means 1 month, only one therefore. So how depreciation? Furniture sold. This furniture is sold. So on this, how the depreciation is calculated, accumulated. All depreciation is calculated. First year 33,750, second year 62,4,370, and third year 32,2,670. So all total depreciation on the machine sold, total it is 1964. Okay, this figure you have to find out first. And here also you have to find out the machine cost. Then 6 month depreciation, first 15,000 we will calculate on 4,50,000. Okay, we will reduce it. Whatever the value comes, it is your written down value. So after reducing it, it is written down value. So on it you have to calculate. Every year you have to calculate on it. Okay, so you will calculate 15% on 60 on 416,250. 15% you have to calculate as per the written value. Okay. Then whatever is reduced, again it is the written down value. So on this you have to calculate for the 3 months, because machine is sold on 1/7, means April, May, June. 1 July we don't take, so 3 months depreciation is coming here. It is 6 months because purchase on 1/10/14 to 31st March, 6 months. And it is 1st April to 30th June, because 1 July it is sold 3 months. So 3 months, 15% you have to calculate on which value? On this written down value. This is your written down value. On this value you have to calculate. Now you have calculated, and so this is again your written down value, WDV. It is your WDV, the written down value. This machine is sold for 2,25,000. So whatever loss, the difference is your loss. So this is the loss amount. So this you have calculated. And annually, how you will pass the depreciation account? First machine, you have calculated 15% on it. Then again on the written value, you have to calculate 15% for 1 year. Then again, this machine is not sold. So for whole year, you have to calculate on written down value. So depreciation, total depreciation is annual. Total annual depreciation. Annual depreciation also you have to calculate. So this and plus this you add, this is first year. Then this amount plus this amount equal to your second year's amount. And this year 13 to 6. So this year it is sold, so here it is nothing, only this is remaining. So this amount will go to your accumulated depreciation. Means 37,500 will come here, this will come in the second year, and this will come 37 in the third year. This is first year, this is your second year, and this is your third year. Okay. And this 37,267, it is coming from the calculation, 3 months calculation, it comes here. Otherwise, depreciation account, whole year's depreciation, you have to credit to the depreciation account. Now, this calculation part we have seen. Now, we are going to the journal entry, this ledger entry. So, ledger entry, I told the furniture account will be always on the cost price. So, whatever the cost and cost was 450 plus installation, of course, you have to add, and the bank account, second machine. It is the second machine and it is your first machine. Okay, first machine, this is. So, its balance will come here next year. Then again, its balance will come here. Now, this third year, you are selling one machine. This original machine, you are selling for 4,50,000. So, whatever the cost price of the machine, it will be reduced from furniture account so that balance in possession, machine in possession will remain only the second machine. So, second machine's cost should remain. Other part you have to dispose of. So, furniture disposal account will transfer the amount, the cost of machine sold, and the balance should remain whatever machine is lying with the furniture is lying with the factory. Okay. So, this way. So, you have debited furniture disposal account. We will create account furniture disposal amount. Buy is debit, so its debit side will write to furniture account 4,50,000. Then this machine is now sold. So it's accumulated depreciation, whatever depreciation up to the previous annual. Previous annual means March and July. This all the depreciation you have to transfer here up to the date of sale. This accumulated depreciation on machine sold up to the date of sale. You have to transfer. We have calculated. You see, 33,750 1 year, 62,4,370, 30,2,610. So all together, first 33,750, then 62,4,370 and 33. So 19,454. This accumulated depreciation will be transferred. It will get from here. So that's why you have transferred this account. 1,09,000. If you have credited to furniture disposal means accumulated depreciation debit to furniture disposal. Disposal account is credited. So this entry is put to here. Credit side it is you are putting because 2 means credit. Furniture disposal account is credited with this amount. Okay, 1 lakh. Then bank account money you have received. So that also will be credited to the furniture sales value. It will come here. And then the difference loss is here. PL account you will debit the loss, whatever loss is coming, and it should agree. Now here this I have already explained. This I have already explained to you. Now in this way question 6 is over. Now one more question 10 we will take. Okay, thank you. Question number 10 now we are doing. Previous questions we have done on written down value method. Now you remember the fixed method. So if in the fixed method we are going to sell a machine and also we are preparing truck machine disposal, that asset disposal account also you have to maintain. Then how we will do in fixed method. Written down value method previously I have told, now it is a fixed method question. So here this your carriage transport company, they have purchased 5 trucks for 2 lakhs. So when one truck cost is, this is 5 trucks. So one truck is of 10 lakhs or 10,000. 10 lakhs you divide by 5. So cost of each is 2 lakhs. 2 lakhs each. Okay. So here you have purchased for 2 lakhs and the depreciation 20% fixed method. So truck account I always told you when provision account is maintained, it is always on the cost price, and whenever anything is sold, it is credited to the asset account, and the balance in your hand that should only remain. So in this question on 1/4/11 it was purchased, then balance is casted, this balance comes here. Then again the next year the balance is casted, this balance came here. Now in the third year on October means 1 January to 1st October. So October date we will not take, we will take up to September. So after 9 months one machine is sold. Out of this machine 2 lakhs rupees machine is sold. So and on the same date they have purchased another machine of 1 lakh and spent some overhauling expenses of 20,000 on it. So that will be also debited to the truck cost, truck account, asset account, it will be debited. So this is your it is 20,000 on overhauling. This is your overhauling. This is your overhauling, and this is your cost. Okay, on the same date. So by 1120 it will match. So how much machine will remain with you? Out of this 10 lakh, 2 lakhs will go. So 8 lakh rupees is remaining. So 8 lakh is remaining. And 1,20,000, this new machine you have purchased 1,20,000. So how much in hand? 9,20,000 is in your hand. So that's why it is. Now truck disposal account, how we will prepare? Whatever the balance we are selling, it is debited to truck disposal account. That's why truck disposal account is debited and created to truck account. The asset account is created. Whatever asset in the question is given, you will write that. In this question, it is truck. That's why truck we are using. So this 2 lakhs rupees from here, it comes to here. Okay. Your cost will come here. The cost way of the machine dispose is written off from here and is credited to here. Then from this, like the previous question, the only thing is calculation part. So accumulated depreciation is first created to it. Then whatever an insurance claim, of course. Previously machine was sold, here insurance company admitted a claim. They have not paid, they have admitted. That's why your general entry is insurance company debit to truck disposal account. Truck disposal account. Your entry is this one. And when the payment will come, what your entry will make? Bank account debit, when you will get the claim to insurance company, when payment will receive. Then this your entry will pass in the general entry. Okay. So insurance company is debited by this debit. 70,000 claims they have accepted, so they have kept. And it is created to disposal account. The difference is 30,000. This loss is your difference figure. It is your difference figure. The difference figure is your loss. If it is the profit, it should come to. In insurance claims, there is no profit. Never a company will not allow profit. So it is always loss. But if it is sold on cash, then the profit, instead of loss, if you are getting a profit, then it should come by to PL account, credit side, it will come here. Now, the provision for depreciation, how it is calculated, I told you every year, depreciation account, provision account is created by the amount of depreciation. So every year it is created. So first year 9 months only. First year 9 months calculated, 20,000 of 10 lakhs, it is 1 lakh, because for 1 year it is 2 lakhs. So for 3/4 month, 3/4 by 2 lakhs we will divide by 4. It comes to 50,000. That's why from 2 lakhs 50 we have reduced 1 lakh 50,000. You can make calculation also like this: 2 lakhs into 9 upon 12 into 20 upon 100. By this way you can make a calculation. So it will come here. Then the second year 10 lakhs 20%, it is full year, so 2 lakhs. Now it is 2 lakhs, because 10 lakhs rupees 20% is 2 lakhs. So second year also it will, by depreciation account, it gets the credit. Third year, and every year you have to cast a balance. This balance always like this way it comes here. This way it comes here. Here also the balance will come this way. So this 350 balance is now with you. Now on 1st July, first 10 you have sold a machine. So whatever the sold machines, the accumulated depreciation, that part you have to reduce from the depreciation provision account, because this machine is sold. So its provision is now not required. So whatever provision is not required, that is the part of the machine or the asset sold. So this asset accumulated depreciation is reduced from the provision account. So we debit the provision for disposal that account, and this entry is put to here. Entry are the same. Only thing, calculation here it is fixed. Previously it was written down value method. So it's depreciation, how calculation of accumulated, how first year 2 lakhs, 20% of 2 lakhs is equal to 40,000. Okay, so for 9 months it is 30,000. For 2012 whole year it is so 40,000, and 2013 it is 9 months, because on October you have sold the machine. So that's why it is 30,000. Okay, this is the 30,000. This is 30,000. Okay. And accumulated total is 1 lakh. So this total figure is this one. This is your total disposal account. Whatever accumulated amount is there, it is transferred to the disposal account. It is your annual depreciation provision account gets the. So here annual year end will not come. On 1st October itself, you have to pass the depreciation entry. This is annual entry. Whatever is remaining with you, third year, whatever is remaining with you, this is in 2013. What will now remain with you? With you, 8 lakhs rupees out of 10 lakhs, 2 lakhs is sold. So only 8 lakh rupees machine will be remaining with you. And rest one new machine, 1,20,000 you have purchased along with the cost. Okay. So 1,20,000, 20% on the new you will calculate for 3 months because it is purchased on 1st October. This date, be careful. This date first time, whenever machine is sold, then also you have to be careful there. Okay? You have to take the care. So it is 6,000 for 20% of 3 months. It is 6,000. So this all together 166. So that's why 166 we have put it here, the third year. Okay. So by balance and whatever the balance is, this total we will make. The total we will make, and the same total will come here. This is the balance. Your difference figure. Your difference figure. Difference figure. This is your difference figure. Okay. So it will go here. So in this way, this question is over. Now, the rest questions we will cover in our next video. Thanks for watching. If we will get views on this, then only we will put some further questions. Otherwise, we will not put further questions for depreciation. Okay. And this chapter we will treat as a over. Okay. Thank you for watching.